You gotta be flipping my flapjacks right on the floor. Look at this, baby. $98,000 down for the public count here today. Folks got smacked a little bit. Hey, that's what we call the cost of doing business. Alrighty, guys, a bunch to get into in this video here today. First off, we're going to talk about fear and greed index. The new AI sentiment numbers just came out. I want to talk about that. Then after that, we're going to talk about what stocks I will be buying tomorrow. I'm going to be buying pretty darn heavy actually tomorrow. So I'll talk about what I'm up to there, why I'm doing it. Then we're going to get into Adobe earnings. I want to share some opinion perspectives on Adobe, ADBE. From there, I want to react to this beast clip here in regards to the markets and listen to all these individuals' opinions and kind of share my opinion perspectives there. And then Kathy Wood and Tom Lee. Oh boy, this is going to be an interesting one. Looking forward to reacting to that one at the end of this video. I appreciate y'all for joining me as always. Thanks so much for being here. Got a lot to get through. I just want to get straight rolling here. If you guys don't mind, just smash a little thumbs up icon, that little like button. That's all I need from you, okay? If you want to be subscribed to the channel, make sure you're subscribed because you might be able to see more of my videos in the future or not, okay? Alrighty, guys, so let's get rolling here right off the bat. Obviously, rough day for the public count here today, $98,000 down. We got a market that's, we can call it, it's a kangaroo. It's, at the end of the day, it's a downtrending market, but it's not, let me be very crystal clear about this. We're not in a crash right now. We could go into a crash if things got dramatically worse and everybody freaked out and panicked, right? But let's be very clear. This is what I call a small correction, what we have had transpire over the past few months. And so this is not a 2022 dynamic. This is not a 2020 dynamic. Certainly, this is not a 2008, 2009 dynamic. It could go there. That's always possible. But as of right now, it's not. This is just like, you got to understand, especially for anybody that's watching this, that you're kind of a noob investor, you're in your first year or two of investing. This is what you have basically every single year. Almost every single year in the stock market, you have a small correction at some point in time. A small corrections, let's call it in that 5 to 10% range for the S&P 500 and for the NASDAQ. Now, we start talking about a large correction that might happen every 2 to 3 years. That's when we're talking about a 20%-ish down move for the S&P 500 and for the NASDAQ. And then when we talk about a 30% plus move down for the S&P 500 for the NASDAQ, that generally only comes every, we can call it 5 years or so, 5 to 7 years. So that doesn't happen that often, but it does happen. So just understand that's what's going on here. We got a kangaroo of a market. Fear and greed index, listen. I like what's going on here. We're now into extreme fear for the fear and greed index. This is still not super low for this. I've seen it before at 3. I think I've even seen it at 2 before. I don't think I've ever seen it at a 1, extreme fear, but I have seen it at a 3. I've seen it at 4, seen it at 7. Extreme fear. So, this is pretty darn low, but we can go lower. If you get some more panic in this market, you get some more put option buying activity, you get some bigger sell-offs, you get that VIX to pop more, we could have this fear and greed index explode higher. And it's not my favorite thing to look at to know if you should be loading up on stocks or not. The better metric, in my opinion, is the VIX. VIX over 30, really good. VIX over 40, great. VIX over 50, load the boat, unload it all, man. So I like this, but I like the VIX straight up better for judging, if you should be loading the boat on stocks or not. New AI investor sentiment numbers came out. This is how individuals are feeling about the market for the next 6 months. We're down to 31%, just under 32% are bullish on the market the next 6 months. Meanwhile, it's up to 46.4% are now bearish on the market for the next 6 months. So this is, this is always a good contrarian indicator to look at. When you start approaching a 50% number, for, basically investors feeling bearish about the market the next 6 months, that's actually great news for you overall. That means you've already got people in a lot of panic. So if we see another high 40s number or a low 50s number coming next week and you see a continuation for the next few weeks, that's actually really, really good news if you're thinking about, buying stocks, taking advantage of the dips and, ultimately riding this thing out on the other side, Okay, so let's talk about some stocks I'm going to be looking at buying tomorrow, which there's several of them. I'll be buying in the public count tomorrow. I'll be buying in my Patreon portfolio tomorrow. I'll be buying in probably almost every single private portfolio I have tomorrow as well, including some big boy buys, okay? So some of the stocks that definitely come to mind right off the bat that I'm like, I got to get some of that. Elf on a shelf, for sure. Elf, trading at 72 here today. That's a good deal. Elf, it's been a crazy past year for Elf stock. I mean, this stock had a low around that Liberation Day last year, right around $49. Then it rides all the way up to just under $150 a share, 146 right here in September. And then here, then we have a low here back in November, about 69. Here today it's 72. It's been everywhere and in between. At the end of the day, ELF is a great buy for somebody like myself that's a long-term investor. EL, I'm surprised, EL's seen this much damage. That stock looked like it was, basically it's going over 100, never coming back. But since we've had all the market drama, right, this one pulled down, got pulled down with the whole market. And so in the 80s, I'm like, this is a steal deal. Like, this is the best thing that could have honestly happened to investors out there. This one had a low in Liberation Day, just like ELF, right about $49. So do keep that in mind. But yeah, EL, I mean, if anybody hasn't started a position, you should be very lucky that you got it back under 100 again. Same thing with ELF. Both of these stocks. It's like, if it wasn't for all this stuff going on right now, these stocks wouldn't have gone under 100 again. But since the market's been so weak recently, they both went under 100 and quite significantly under 100. It's not like they're at like 99 or something. No, they're quite significantly under 100. HIMS I'm still taking a look at, trying to see what's going on there. Cheesecake Factory, yeah, that one sold off pretty heavy today. That's a good buy, but I won't be buying that one tomorrow just because I have so many shares in cake. But you never know. I could be, right? Bath & Body Works, I really want to start a position, but I think I'm waiting on Bath & Body Works until April. So the stocks that would fit into that criteria of me waiting till April is Bath & Body Works, RH, and Whirlpool. Those three stocks, I really, really want to wait till April to start my positions. I just want to finish out building some positions that are existing positions in my portfolios. Then I'm going to worry about new stocks like Bath & Body Works, RH, Whirlpool, those sorts of stocks. And I just have some more shares I want to buy in my portfolios of some of these existing positions, like an ELF, like an Estee Lauder, right? SoFi, this is one that getting it under 20, this would not have happened if we didn't have all this market weakness recently, right? This one reached up to 32 and it kept climbing. I mean, it was unbelievable. This one set a low back right around Liberation Day of just under $10 a share. Then it goes on a run to 32. Now it's a huge pullback to 17. That's one of those things as a long-term investor or somebody that maybe hasn't built a position in SoFi, but you need to just say thank you. Because, if it wasn't for all this drama going on right now, you wouldn't be getting this stock at $17. Not with the sort of growth rates this company has. They're incredible. Celsius, same exact thing. Celsius is one I would love to buy some shares of tomorrow. All right. So far we have Celsius, SoFi, Estee Lauder, and ELF. The heaviest buy is likely an ELF, SoFi, and Celsius for me. Hood I'm taking a look at. That's one of those, if I do end up buying it, it won't be until the second quarter, which second quarter starts in April. So that's one I'm just taking a peek at here. Honest, this one I could buy tomorrow as well. Not as far up on my list of importance in regards to buys tomorrow, but I would love to get some Honest while it's still under 3. It's still a $2 chuck. So Nike, NKE. Oh my gosh. Do we need to have an intervention about Nike? This stock is just, it's incredibly weak, right? This is another one of those that it was climbing and it was looking good. And then all of a sudden market started to weaken and it's just falling off a cliff again down to 54. I mean, it's just a steal deal. I don't know what else to say. As a long-term investor, there's just certain stocks you get and it's just a steal deal. And I look at Nike as that sort of deal. It's just been so out of favor for so long, but at the end of the day, the companies are going to put up their numbers. I think Nike's going to put up great numbers over the next few years, and that will be that. PayPal, 44. Yeah, it's a buy, but at the end of the day, you know what? I'm not usually in favor of call options, but I do have to wonder if call options are a play for PayPal. Assuming that stock spikes huge on a buyout, a potential buyout, right? But the risk is the buyout never comes and then the stock stays dead money. That's kind of the risk there. But I was just thinking, I'm like, dang, man, calls. And I'm sure calls have appreciated greatly since the buyout rumors have started. So do keep that in mind. If I was to buy calls, it would be probably January 2026s. That way, in case a deal doesn't get announced till third quarter, fourth quarter, you're covered, right? Meta's always a buy along with Amazon, right? Those stocks are out of favor. I've spoke about them many times. I think I spoke about them on the main channel last night. ServiceNow, I think I'm good on ServiceNow. So I might get a little more ServiceNow. I might get a little bit more. Whirlpool, we spoke about that one. Fubo, yeah, $1. Okay. Amazon, always a buy. Adobe, we'll speak about that one in just a moment. American Express, yes. Give me every share of American Express in sight. Anything around this $300 level, and especially under 300, absolutely. CRM, I'm good on CRM now at this point in time. My position's built out. Like, I just feel comfortable where I'm at in regards to that one. Adobe, next up here. So Adobe earnings came out. Yeah, guess what? It's not the end of the world. Yeah, Adobe's just fine, as they've always been. B+ grade income statement here. So there were some really good things. There were some not such good things here. 12% revenue growth for Adobe, very strong. Total cost of revenue only up 7%, so gross profit went to 13% up year over year. R&D was up 8%, that's not bad. Sales and marketing, on the other hand, was up 14%, not good. We don't want to see that up at a faster clip than revenue. And then G&A was up really high during the quarter, 26%. We've seen a lot of companies take some big hits to G&A recently, specifically this last quarter. 26% there versus revenue growth of 12%. So total operating expenses are up 13%. We don't want to see that growing at a faster clip than revenue. So that's why I circled it red there. Operating income was up 12%, so it's a good number. I did a blue and a green here because it's a really good number, but we would ideally like to see operating income at a faster clip than revenue. So if revenue is up 12%, you really want to see your operating income up 14, 16, 18, 20%, something like that, right? But they just got a couple line items that they need to cool down over the next bit of time here. They got killed on income taxes here. They took a 44% increase year over year hit from income taxes. That's a lot of companies have been taking kind of some weird tax hits here at the end of the year. I think some of it has to do with the big beautiful bill and some tax changes in regards to that. So they took a huge hit there. So net income was only up 4% year over year. But once again, a lot of that's because that 44% increase in taxes on a year over year basis, right? The most insane thing is diluted EPS was still up 11%, even despite that crazy tax hit, which makes you think if it wasn't for that huge tax hit, diluted EPS probably would have been up 15, 20% easily, right? So I give him a B+ grade. It was good, solid income statement. It wasn't great. If these would have cooled down a little bit, I think it would have been a great income statement. I could have given him an A grade or maybe even an A+ grade. But because those line items were a little high there, they got a B+. So that's Adobe. Now, in regards to Adobe, I got to point something out. It's very important everybody understand this. Watching this right now understands this. Okay, listen. Look at what they grew revenue in this latest quarter. It was 12%. Okay, this is very important because there's all these worries about is Adobe going to be disrupted? Are they being disrupted? All these AI tools have been launched over the last few years. Okay, look at this. So they were expected to grow 10%. They grew 12%. Then 10% last quarter, 10%. 10%. So we're looking at the year over year number, by the way. 11%, 10%, 10%, 11%, 11%, 10%, 10%, and 9.2%. So they are accelerating, ladies and gentlemen. They're accelerating their revenue growth rate here at Adobe. So the worries about, Adobe's dead or Adobe's dying, how can you make that case when the revenue growth is accelerating? If you want to make a debate that their margins are going to get hit or they're going to overspend here in the short term or something like that, you can make those debates. Those could be fair debates. But does that even matter when your company trades at where Adobe trades at, right? Look where Adobe trades at in regards to its valuation. This is going to be pretty shocking. Keep in mind, if this stock's down tomorrow, right? The CEO's leaving the company. He's been CEO, I believe, for 18 years. So he's, I think, going to kind of... let's call it, say, peace out. Like, he's still going to be involved with the company, but it looks like he's ready for kind of at least semi-retirement, right? Forward P of 11 on Adobe. Come on now. Forward P of 11 for a company that's accelerating growth rates, I think it's a buy. I'll probably buy some shares tomorrow. We'll see. All right, let's talk some markets, and then we'll talk Tom Lee.
The roller coaster ride continues that we've been on.
By the way, before we get into that, the main pinned comment down there today is if you're looking to apply to join my private stock group, get access to all of my premium courses, access to my private Discord chat, access to exclusive weekly videos inside the private group, access to 1000xstocks.com, my advanced software I use on a everyday basis, which is very in-depth, and we're taking it to higher and higher levels. You can run projections, intermediate projections you can run through your base case, bear case, and bull case. Also, we have our advanced projection. So if you really want to go beast mode with it, you can take numbers all the way out to 2030 and adjust countless line items here. We have our beautiful charts feature that I was showing you, compare feature where you can compare 3 stocks versus each other, all the different metrics, line them all up. Oh, it's beautiful. So anyways, that will be the main pinned comment down there today. Oh, and listen to earnings calls right through it as well. Look at this. And you get the AI transcripts. Oh, gosh. We're taking 1000x higher and higher levels, ladies and gentlemen. That will be the pinned comment to apply to join us in there. Enjoying the 6, 7, and 8 figure members.
For the better part of the last 10 days, and we are unfortunately all becoming oil traders. The problem is that the real professional oil traders right now are not even confident on what they've relied upon in the past. Sentiment and positioning, that has given way to this dislocation where it is all about a very intense and complicated military operation. And we're seeing significant headlines. What that means for the oil trading community is that there is less participation. There is less volume. If you look at the average volume for spot crude oil at the end of February, it was 300,000 contracts per day. As we approached last weekend, it was up to 1 million contracts today. You got up to $119 Sunday night, and every day since, you're seeing the volume declining. So that is a very choppy environment to be in, unfortunately. Could we bleed lower? Yes, but remember, structurally, we're still in a bull market. We still sit about 1.5% above the 200-day moving average. And candidly, less is more right now. It's a moment to really just kind of step back, observe the environment, and allow this to unfortunately play out.
You could get out of a bull market pretty quickly if things go even more south than some suggest they're already heading, certainly from an oil and energy standpoint.
Listen, ladies and gentlemen, let me push back here for a moment. I do not believe we're in a bull market right now, right? And I just think that's kind of factual. Like, you take a peek here, we topped out this NASDAQ way back in December. Now we're deep into March. I mean, December feels like a long dang time ago. NASDAQ's down about 7% from all-time highs that it set once again back in December. Yeah, that doesn't feel like a bull market anymore at this point in time, right? It feels like a downtrending-ish, kangaroo-ish market, right? And so that's fine. Like, that's just where we're at right now. We could get back into a bull market, or we could take this into an actual bear market. But let's be very clear. We need big moves on either side. I'm not going to count us in a bull market again until we break new all-time highs in the NASDAQ. So until that happens, I can't say we're in a bull market. And I can't say, we're in a bear market either, because 7% move off all-time highs for the NASDAQ, that's nothing crazy. We start talking about 10%. Okay, now we're getting interesting. 15, 20%. Now we're talking, right? 20% plus. Yeah, we're in a full-blown bear market at that point in time. So, yeah.
And the fallout. Jonathan Krinsky of BTIG, as we come on the air, just publishes a note moments ago in which he says 6,550 to 6,600 on the S&P is now critical. Closing below 6,550 would suggest a meaningful top, with a downside measure towards 6,000. That was just published by Jonathan Krinsky of BTIG, in which he says losing patience, breath erosion, and financial weakness is just simply too much to ignore at this point. What do you think, Steph?
No, that doesn't make me feel good, but up until this point, we're only down.
You felt good before I read you the note?
Well, we're only down 2% on the S&P 500. Now, I know that there's a lot of damage way worse underneath the S&P 500, but it is encouraging that it's holding up, and you are still continuing to see different kinds of rotations. Look, the markets do not like uncertainty, and a war is maximum pain. We have no idea the details. We have no idea how long it's going to last. We just don't know. Every day that there could be a new development. A new tweet for all we know, right? On the negative side, clearly oil prices are, it's worrisome to see the velocity of the move. But when you think about it at the pump, right now you're at $3.60 at the pump. That's actually at levels seen back in 2022 and 2023. Thanks, Brian Sullivan, for pointing that out earlier this morning. It's not demand destruction.
Listen, we're not, just factually, we're not in a bull market. We haven't been for quite some time. The bull market really ended in October, in my opinion, because that's when we saw the biggest, most impactful companies in the world, the ones that matter the most to the stock market, they all pretty much peaked. I know Meta peaked right around Halloween. Look at NVIDIA. NVIDIA peaked way back in October. October feels like 100 years ago now at this point in time, right? Look at right here back in October, shortly before Halloween, NVIDIA peaked. right at kind of that 207 level, somewhere around there, right? And it's never been back there again. And so, when NVIDIA sets a new all-time high, which I don't know, that might be a while, but whenever that happens, okay, we can call a bull market again. Or when we get into a dynamic where the market goes into a bear market, right, and then we bottom out the thing, and then we start heading up from there, then I'll say, okay, we're back in another bull market again. But this is a downtrending-ish kangaroo market that gives buyers great opportunities, and it doesn't surprise me. Valuations had gotten really frothy around that fourth quarter, the beginning part of the fourth quarter last year. Valuations were very frothy on NVIDIA, on Meta, on all stocks, right? Not frothy to the standpoint of whoa, this market's insanely overvalued. We need to crash 50%. No, but valuations did get stretched on a lot of stocks, and obviously stocks like Palantir. Palantir is another poster child of, a stock that maximum excitement valuation play. And look at this one. This one peaks right around Halloween at 208 right there, right? So the moral of the story is here, we're not in a bear market. We're not in a bull market. We're in a kangaroo downtrending market right now. And until we get a much bigger move to the downside, we can't say we're in a bear market, or until we start taking out all-time highs in some of these stocks, you can't really say you're in a bull market. As long as we're in these ranges, we're just in a kangaroo. And sometimes you go through kangaroos for months. Sometimes it could be a year or two. So we've now been in a kangaroo, I would say, for, roughly 6 months. Let's just call it around there. Roughly 6 months we've been in a kangaroo, and that's fine. As a long-term investor, you get to snap up great stocks, great valuations. And hey, if you own dividend stocks, you're getting paid out all this dividend money every 3 months. It's beautiful.
At 360 yet. So obviously that's why we're waiting. Now, that's kind of the negative and the uneasiness. And I'm also not crazy about bond yields keeping on the upside. But on the positive side, Scott, the data in the economy is actually all right. It's pretty good. The Atlanta Fed tracker, I know I probably just stole your thunder, Jimmy, but it's at 2.7%. Everyone was panicked on the non-farm payroll numbers on Friday, and we got great initial claims this morning. And also, retail sales have been good. Look at Costco. Look at Dick's. Look at Walmart.
I just feel like all of those metrics, granted, they're all good. They're all almost meaningless because they're
productivity is the thing I was about to say, and that's
backward,
not. No, and productivity is no, and productivity is not backward looking.
I'm not talking about productivity.
But that's what I was going to add as my fourth and final point. Maybe these other things change, certainly, but right now, the numbers are the numbers, and productivity is a very big positive, and that's a nice tailwind and offset. And one last thing, one big beautiful bill has yet to hit, and that will help in terms of a little bit of the oil price, maybe the inflationary pressures.
I'm sorry to interrupt Jimmy and Josh. I agree with everything you're saying fundamentally. To me, where we are in the moment, can you secure the Strait of Hormuz or not? That's what everything boils down to. And if we can't, then this punitive environment continues. And if we're able to secure it, then we're going higher.
Okay, to that point, it's binary. Obviously, yes. The market is reacting to that, to which JP Morgan's trading desk is making a tactically bearish call this morning. Long energy and energy stocks and short equities. It's really that simple. They say, quote, if we get to a Sunday when futures open without a resolution, we think risk assets will see a more aggressive sell-off. I urge you to go to CNBC Pro, subscribe, and you'll be able to read more stuff like that, because there's a complete write-through on what JP Morgan's trading desk is saying about how to approach this market from a tactical standpoint. It matches with what Joe says. This is a binary issue. Straight open, stocks up. Straight closed, stocks in trouble.
It is a binary issue, Scott. I agree. However, there is another dimension to it, which is time. How long does this last? The longer it goes, the more significant damage will be done. The president has said it's a 4-week operation. If that's the case, and the straits are opened in the next 2 weeks, I think, while there will be damage, there will be damage to profit margins and profit growth, it will be temporary in nature.
We can even stop with the 4 or 5 week, month, this, that, because the messaging has been so inconsistent. Because this morning it was, we're going to stay there until their defeat as long as it takes. So
the reason
Thank you. Yes, 100%. You can't trust any of these timelines. I wouldn't be surprised if, T-Man came out and declared victory in a few days from now. I wouldn't be surprised if this is still going on, months from now. Or I wouldn't be surprised if victory was declared, but there's still a lot of stuff going on behind the scenes and maybe even some troops on the ground. There's a lot of games to play out here. So then it's going to be up to the market to decide, is it just going to go off words or is it going to go off more what the actions are? My guess is the stock market is going to go more based on the actions. So whatever words are said, I don't think those are going to matter nearly as much now. Oh, we're going to wrap this up or we're going to have victory. I think the market's going to look at actions, what's actually going on, and that's how it's going to decide if it wants to go risk on or risk off this market, and if we're going to go back into an actual bull market, or if we're going to go in a bear market, we're going to stay kangaroo.
If you're going to hang your hat
right.
on,
No.
It's going to be 4 or 5 days, or now 4 or 5 weeks, or 4 or 5 months. Good luck.
Yeah, so I agree with you that the messaging has changed day by day, if not more frequently. But what I'm saying is I haven't changed my stance, which is to be invested in a broadly diversified equity portfolio. So I'm not taking the J.P. Morgan advice, not yet. And the reason is because of what you're saying, Scott, because of what you're saying, Joe, that if the straits are opened tomorrow or a week from now or 2 weeks from now, I don't think enough damage will be done to upset the significant positive forces in the economy and the markets, whether it's stimulus from the budget bill, whether it's artificial intelligence, capital expenditures. The straits being closed will leave a mark, but it will not be fatal if it's opened by the end of this week. And I do want to point out one thing regarding oil, that there are cushions involved here. We have to remember, before this started, there was a very significant surplus of supply over demand. And it's not, it's a matter of time before the Baker Hughes rig index starts to creep up, particularly here in the U.S. That has been very moribund for years.
You just said as long as it's open by the end of this week. You realize today's Thursday.
No, I'm sorry if I misspoke. I meant by the end of the month.
Okay.
Okay, so regarding, we do have an issue here. I'll speak about that in just a moment. Let's finish
end of the month. Thank you. Let me be very clear. By the end of the month.
Okay. So, Josh, B of A today in their commentary is, obviously about risks to the macro. And that's really what this whole story boils down to, in which they say we think markets could be underpricing the odds of a synchronized global slowdown. In the emerging markets, positioning is now much cleaner and interesting opportunities have emerged. That's consistent to where people have thought there were better opportunities anyway in the emerging markets rather than in the U.S. market for a variety of issues. We don't need to really go there at this point, I don't think, but the idea of the markets underpricing a scenario in which you have a synchronized global slowdown.
So everybody's worried and concerned about, gas prices going up. So, an average American has to pay $10 extra a week or $20 extra a week or $30 extra a week, right, to gas up their vehicles, right? That's concern, but I think there's actually a way bigger concern in regards to if you want to go through the thought process of worrying about the economy, which then could affect earnings negatively or something like that. There's a way bigger thing I think that should be talked about. And you know what that is? It's the higher end consumer. If we understand what has kind of bailed out the economy over the last few years, it has really been the high end consumer. That's where a lot of the spend has come from, right? The high end consumer, we do have some issues with the high end consumer, right? And these are, when I say the high-end consumer, who am I talking about? I'm talking about people that have incomes of several $100,000 or more a year, right? I'm talking about people with net worths of $1 million plus, right? That's where a lot of the spending in the economy has really come from. We do have issues there, okay? Here are the issues. One, there's a lot of worries about AI potentially taking jobs. We all know this, right? And so that creates a dynamic where if you're in a space where you have some concerns about your job security due to AI, might make you spend a little less, right? Additionally, when it comes to higher net worth individuals, we know they're very heavily invested into the stock market, specifically a lot of tech stocks, right? And a lot of the big tech stocks, and also things like Bitcoin, Ethereum. Well, things like Bitcoin, Ethereum, not doing very well, obviously, right? Bitcoin is down probably 40-45% from all-time highs it reached last year, which that one, I can't remember if it reached all-time highs in the summer or in the fall, but it's down about 40 or 45% since then. Ethereum's down 50% plus, right? So if you're investing in those, you don't have too much of a wealth effect going on. The Nasdaq's down roughly 7% from all-time highs it hit, way back last year. So if you're thinking, and that's why if you're thinking about American Express stock, right, which I love as a long-term investor, and I'm gobbling up as many shares as I can over the next few months, but the short term, we don't know, right? The short term is, a little more shaky when it comes to high-end consumer. You might get some pullback there. And so as a long-term investor, that's perfectly fine. It is what it is. But just in the short term, you do have to worry about that from like an economic standpoint, because that's what's really bailed out the economy the last few years. We probably would have had, I would say we almost, extremely high probability, we would have had a pretty good sized recession. But the high-end consumer for the last few years has really bailed out the economy, man. And so I know the rich and the higher-end income people get a lot of hate, but I'm just being honest with you guys, they really bailed out the economy just on a factual mathematical basis over the last several years.
Yeah, look, I think the big picture here is that I can't remember a time where the S&P has been as close to an all-time high as we are now, with as little conviction as we're seeing. It's really a remarkable thing, and I think the rotation is the reason why that's even been possible. So the problem that we have is that the stocks that are working are under-owned and not large enough to accommodate the people that want to be on the right side of the trade. And the stocks that are really important are just not working. And so when you think about energy, far and away the biggest winning sector on the year, up 27% year to date. I, of course, have been talking relentlessly about ExxonMobil, which, again, is making a high now. But there are a few of these stocks. There aren't 100 like there are in the software group or the semiconductor group. There's just a few. And then you have to dip down into small caps. And that's sort of problematic for the market. The other thing is we have this slow motion negative news cycle, which is now becoming a negative price cycle in private equity. Very quietly, the XLF is in a 13% drawdown. That is very negative.
I don't even know if it's very quietly, to be honest with you. I don't know if it's all that quiet. We've been talking about it
for
a
some
lot,
stocks,
and it's been screaming. It's been screaming for a while that, hey, if the financials continue to have, I've said this numerous times and we've discussed it with numerous guests, if the financials continue to have an issue, you're going to have a really hard time getting this market to have some stability and durability again.
Well, you had a negative labor report that missed expectations, and now you have Bank of America in a 17% drawdown. The credit cards, Synchrony Financial down 28%, Capital One down 31%, and once again, the jobs numbers are now surprising negatively. Not great. The XLF is in a drawdown almost as bad as the Liberation Day drawdown, which was 16%. So we're down 13. We're almost there. And then, of course, you've got the PE/PC segment of financials, which are at this point now in 50%, 50 or greater drawdowns. And now with JP Morgan starting to mark down the assets it's lending against to these private credit firms, it's almost like a self-fulfilling thing where the news cycle is bad, which prompts even more redemptions, which makes the news cycle worse, which worsens the redemptions.
Oh, yeah.
I really don't think that stabilizes on its own. So I know we're talking about crude, and I know we're talking about the Strait of Hormuz, but guys, if that were resolved tomorrow, that doesn't change the bigger issue that we have here, which is that lack of conviction. Last thing, here's what nimble traders are doing. I'm going to give you a couple of tickers. Throw these charts up for me. Here's another Hormuz-related supply disruption, this time in the materials space. Look at these rallies. CF, plus 13%. Mosaic, MOS, plus 10%. Dow Chemical, plus 8%. Lyondell, plus 7%. So traders are looking for opportunity from the Strait of Hormuz being closed down, and these stocks are going parabolic. But again, they're not big enough to offset the negatives.
No, but opportunity finds itself in times of upset, as we've learned.
Well, here it is.
Joe, you first day of the war, I think you bought.
Wait, before we go further, I want to show you guys something very important, and it kind of piggybacks off of what he was speaking of there. Listen. When we're talking about the stocks that, you need working in the market, not working, I mean, this bag, I just kind of backed up to around Halloween of last year, right? Nvidia's down since then. Amazon's down about 6.5% since then. Tesla's down about 9%. Meta's down 13.5%. Palantir's down 17%. AMD's down about 22%. Mr. Softy, Microsoft's down 23%. The IGV, which is a software ETF, so all the software stocks have gotten absolutely wrecked. But the IGV itself is down about 27%, right? Those are stocks you need to have working in the market if you're going to have the market working, right? And we just don't have it.
CF.
Sure.
It was the first place I think you went.
And that leads to a lack of conviction in the market. When you've had months and months and months of the stocks you need to have working, not working, yeah, it makes it tough.
In looking for stocks that may have an opportunity to go up on the headlines and the events of taking place in the Middle East.
So
let's talk about that for a minute.
The Iranians are significant exporters of urea. Nitrogen, it's not negotiable, it's mandatory in corn planting, and CF had a 7% short interest on March 1st. That was one of the things that I found so compelling. A very cheap valuation, to Josh's point, 75% revenue growth. So it is one of the first places I went. I bought it at 104. I'm going to be fully candid on something. I do not know.
You're suggesting you're not usually?
What to do with the position right now. So I'm maintaining, I'm holding the position, I'm raising the stop.
Okay.
But again, it's binary. If the Strait of Hormuz is secured, CF Industries is going down 10%. I know that. So you could say, okay, I'll sell a little. I'm not so sure I want to do it. So really, only thing I'm doing right now is trailing the stop, but it is directly related to the war.
Okay, next one up here. Here we go. Tom Lee and Kathy Wood.
And a CNBC contributor.
Oh, what in the 2021's going on here? Oh my gosh.
Welcome to both of you. Tom, you want to just start with your thoughts on the markets? Why is tech kind of not participating this time? They've been a ballast so far in this sell-off.
Yeah, I mean, I think tech in general has actually held up really well, including software. It makes sense to us because, I'm going to make a counterintuitive statement. Higher oil is relatively good for U.S. equities because, one, the U.S. is a net producer of oil, but as people worry about global growth slowing because of high oil, they want to own growth stocks, which actually makes them want to own the U.S. stock market because it is a growth index, especially the Mag 7 and software. So I actually think that this kind of makes...
In all due respect, Mr. Tom Lee, we're seeing no evidence of that. We're seeing no evidence of that. Have we seen any of these growth stocks doing good? No. So, just not seeing any evidence of that. Oil's gone parabolic, and yet all these stocks that are risk-on type stocks all suck. Like, they just do. So, yeah.
Sense. And I've heard the earlier conversation today. I'm also in the camp that I think we're making our bottom this month for the equity markets.
Okay, what about, we got Jefferies down 7%, Deutsche down about...
So that might sound like a big statement from Tom Lee, but listen, I remember Tom Lee in 2022. He made a lot of big statements, right? And the market just kept going lower and lower and lower and lower and lower until we finally bottomed out that thing in the fourth quarter of 2022. So just understand, just because Tom Lee says, oh, we're going to bottom this month, like, he could be right, but don't take that as a gospel and think like that's for sure. We're bottoming out this market. Like, we could easily continue to go lower for a while. And what do you do as a long-term investor? Take advantage of great deals, if that even happens.
That much. A lot of people are trying to look around, poke into where these private credit exposures and stuff might be. What would you say about that narrative right now, Tom?
Well, private credit's been a problem for some time. So I think it has been increasingly revealing, as Jamie Dimon said, more cockroaches. I do think it's probably not as systematic as we might fear. I know people carry the Lehman hammer and think that this is a repeat of the GFC. But again, there's a lot of reasons it's not a systematic. One is just the size of the market's not nearly as large, but also things that look like credit stress aren't really signaling like they did in 2008. So I think it's hurting financials right now, but I don't think it's a broader problem for the market or the economy.
Kathy, you guys are looking, if I'm...
No, I can't do Kathy, okay? So listen, there's going to be a lot of crap in the short term, right? A lot of worries and things like that. As a long-term investor, you have to look past that. You have to be looking out 3, 5, 7, 10 years, right? And understand for newer investors to the market, it's hard to look that far because you're just like focused on what's in front of you. You got to be bigger than that. There's no, it's like it'd be like somebody saying, I want to get in shape, but I don't want to go to the gym. And I also don't want to eat healthy. And you're like, okay, good luck with that. That's what I hear. That's what I look at when I see people saying, oh, I can't focus long term. I'm only looking short term, and I don't have, 10 years to. Well, you shouldn't be you shouldn't be like gambling your money around in short term things if you don't have time to play with here, right? Like long term investing, we've got to be making investment decisions for the next several years, not for what is being discussed and talked about today. Like, are you kidding me? Or what's going to happen tomorrow? And are they going to open the Strait or not? And blah, blah, blah. Come on, man. And so, for the people that don't want to go through that, you're just like the people that say they can't go to the gym and they can't, eat healthy. And it's like, okay, good luck to you. Like, there's nothing I can do to help you. But for the individuals that would like to be helped, pin comment down there. You can apply to join my private group. That will be access to all my course curriculums, private Discord chat, exclusive weekly videos, all that good stuff. All right, guys, much love as always, and have a great day.